Guys, there's YouTubers out here who are saying even today that Tesla stock is about to explode. And so in this video, I'm going to play devil's advocate and actually see if the stock can explode based on their economic projections. And so while you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And I found this very interesting because this morning I actually released a video on Tesla, and the video essentially concluded that Tesla's somewhat overvalued to fairly valued depending on sort of like how you're forecasting out growth, but you have to be very careful as you're forecasting out growth. You can't use, Tesla senior management's growth expectations because they're forecasting growth over the medium term at 50%, and that's just not plausible. However, I saw this one video that sort of like really stood out to me today. So this was the video. It's by Meet Kevin, who's got almost 2 million subscribers. So, that suggests that there's a lot of people that trust in what this guy says. He's saying that the Tesla stock is about to explode. And I don't know, I think kind of it's been exploding, but just not in the direction that he's been hoping for. Now, but first what I wanted to do is I wanted to start with, what the analyst community is saying. So it's one thing that YouTubers out here are saying that Tesla is expected to explode. The other thing is, what does Wall Street think about it? And so notice that Wall Street has a very strong or buy focus on this name. So Wall Street is very positive on the name. There's 12 holds, 3 sells, but of course 19 buys or strong buys. And so there is a very positive sentiment on Wall Street for the name. But the question is, what is the price target? The first thing that I always like to look at is the price target, because if it's more than 50% of the current share price, you can tell that the analysts are very positive on the name. Well, here's the price target. So you can see that the analyst price target is way more than 50% of the current share price. It's 100%. So the analysts believe that this company is expected to trade at approximately $250 within 12 months' time. So that's how positive on the share price the analysts are. But the next thing that I would like to see, because my valuation doesn't support 250, my valuation supports 120. So the question is, do I expect analyst price targets to increase, or do I expect analyst price targets to decrease? Now, why would I make that comment? The reason why I make that comment is because analyst price targets typically follow the share price. They don't sort of lead the share price. And so let's take a look. And I'm only saying this because I was in the business, right? I was on the sell side of equity research. So notice, and I just said it earlier, but recall, the analyst price targets follow the stock price in most situations because they are 1-year price targets and not intrinsic value price targets. And so, the valuation that I provide on my channel for, the way that I'm doing research for myself and the research that I share with you guys, that's an intrinsic value. This is a 1-year price target. And so notice that we currently have a large gap, which tells us that the analyst price targets, which have started to come down, are expected to come down even more as they follow this share price down. So do not be surprised, and I'll provide an update video here, but do not be surprised if the analyst price targets, which is currently, between 200 and 300, so that 250 comes down to that 150 level just to close this gap as the Tesla price continues to decline. The only thing that will cause analyst price targets to come back up is if the current share price rebounds and starts surging again. So we'll see how this plays out, but my expectation is that this gap sort of converges by the analyst price targets coming down. But like I said, price targets are just price targets. They're just 1-year earnings estimate. They use a multiple. They could be doing it relative to sales. They could be doing it relative to free cash flow, whatever they want to do. But the real way you can tell what analysts think about a stock, especially is how they would build out an intrinsic value model as opposed to the 1-year price target model, is by looking at how they think earnings are going to roll out. And the best way to sort of think about that, especially with Tesla, because it's a growth stock, is look at what the analysts think in terms of the revenue growing for Tesla. And so if you're seeing, 35, 40, 50% growth rates, you can understand why the analyst community would be very bullish. However, if I see revenue growth rates that are under my revenue growth rates, or even at my revenue growth rate, which is effectively 25% for the next couple of years, and then it significantly tapers down, then I would suspect that their intrinsic value or their intrinsic valuation is closer to mine. And so let's take a look. So you can see these are the revenue estimates that are being provided by the analysts. And so you can see there's 36 analysts for 2022, and then it goes boils down to 13 analysts for 2025. So there is quite a sample here. And notice that the analyst community actually does not buy into Tesla's 50% revenue growth outlook. In fact, they largely align with how I'm forecasting revenue growth at approximately 25% over the next couple of years, which is approximately half of management's expectations. And then the other point that I want to point out is that the analyst community is baking in a steep growth decline in the rate of revenue growth. They are not forecasting 35% annual growth like the YouTube finance community is doing. And this is how the YouTube finance community is getting to these high valuations of $1,000 per share or more. They're forecasting very high revenue growth rates. So the point that I'm making is that if you are one of the people that are forecasting 30, 40, 50% growth rates, the Wall Street analysts themselves do not agree with you. And so here's a clip from that Meet Kevin video where he actually says that it's easy to forecast 30% or higher growth for Tesla.
If it's growing earnings at 30%, is not that unreasonable at all. So the only way you could be a Tesla investor, in my opinion, is by believing in the growth story.
And so the question is, why are they forecasting such high growth rates? Well, here's why. They're effectively looking at the outlook that's being provided to them by the management over at Tesla. And management is saying that over a multi-year horizon, we expect to achieve a 50% average annual growth in vehicle deliveries. So what the YouTube community is doing is they're saying, listen, we're not going to say that this company is going to deliver 50% growth year over year, but we will take it a little bit on the conservative end and forecast out 35%. What I'm saying is that look at the numbers, look at the competition. It just doesn't make sense. Now, I could absolutely be wrong. So there's a level of humility that's required here. Tesla could absolutely blow it out of the water. I just see a highly competitive environment where Tesla is less competitive, especially as more and more vehicles and offerings are made in the environment. And the point that I'm trying to make is that these electric vehicles aren't going to take over the whole market, right? There's a certain amount of people that these EVs appeal to. And there's just more and more supply that are appealing to these people. And so growth acts like an anchor. It's going to slow down. When does it slow down? I'm not really sure. I'm not the expert. I do know that the Wall Street analysts look at this all the time, and they're forecasting revenue to decline as well. So if the major institutions are even telling you that the revenue is not going to continue to grow at 35% a year, who are you? What sort of insight do you have that the revenue is going to grow at that rate? I'm just not seeing it. And so the question is, what am I seeing? Well, I'm seeing that they're having exceptional 2022. So you see that I'm giving them a 61% increase in automotive sales, and that's effectively their run rate. So they are going to grow total revenues out at 60% in 2022. That's what I do believe that's going to happen. But we are treading into potentially rough 2023. And so despite that, I'm giving them a 50% of their automotive sale growth rate. So instead of the 25%, it's half that. So 50% of that. So in other words, 50% of 50%, which is 25%. And I'm giving that to them for the next 3 years, not 5 years as it says here. And then I'm bringing that down considerably to 10%, which is still exceptional. I just find it hard to believe that they grow so fast while everyone else is releasing great EV products. But you are free to disagree with me, and that's okay. Nobody's perfect. I could be the one who's getting this wrong as well. And then the other thing I'm doing is I'm being optimistic on their costs of revenue. I'm saying that their cost of revenues maintain at this high level. And why is that optimistic? Well, if you have more competition, you're going to have pricing pressure. You're already seeing Tesla reduce the price for their vehicles. Well, if they're already reducing the price for their vehicles, then are they even going to hit the gross margins that I'm forecasting here? I don't know. And I think as you have more and more competition and better competition, you're going to have to reduce those gross margins substantially as well. And so once again, even if you hit those revenue growth estimates, if you're taking it on the chin as opposed to the price that you're selling these things at, just to maintain your growth momentum on the top line, you're still not making money for shareholders. So there's quite a few risks here that are not being taken into account when you forecast out these high growth rates and high levels of profitability. And, rule number one with investing is is it sort of like inevitable? Because that's the only way you don't lose money. This just doesn't seem like an inevitable situation where they're going to grow at 35% a year. And so it's not something that I would value in, even in my somewhat optimistic case scenario. And then, of course, I did say this in the video earlier today, but I don't see any of the bulls for Tesla talking about this bomb in their cash flow statement. And so as they've become more profitable, the stock-based compensation has exploded and it remains very high. So this is a silent killer, and we need to discount that from our free cash flow per share valuation. It has to be a free cash flow per share net calculation. Otherwise, you're not taking into account the value that's being taken away from you with stock-based compensation for management. And so once again, here's my valuation. And all I'm saying here is that despite the 70% decline in share price throughout 2022, the company is still overvalued in my opinion. And I think, the fact that the company is still being valued at 57 times next year's free cash flow per share number shows you how much of a growth story this is. Now, some of you guys are saying that this multiple is low. The point that I want to make about this multiple is you really have to look at how the model is built. This is not a price target multiple. This is an intrinsic value multiple. There's an intrinsic value model. This is not a price target model. And so this terminal multiple is being applied to the earnings 10 years out after growth has already slowed. So it's being applied to that company and then is discounting that terminal value back. And so you really have to understand how this is built. I know a lot of people get confused when they see this because they look at the company as it is today and they're saying, well, it's trading at 57 times earnings. Why are you forecasting at 15 times earnings? Take a look at the model, get access to it at the Patreon, and just understand what an intrinsic value model looks like. Now, remember, throughout this whole video, I've been saying that, some of the YouTube finance community, they're forecasting growth at around, anywhere from 30 to 35% or even higher. And I'm going to blow that sort of like thesis out of the water next. So you can see Tesla is one of the worst performing stocks in 2022. There's no doubting that. And I've shown you guys in the first video where Tesla stacks up against all the other stocks in the S&P 500. But notice that some of the current bulls, including me, Kevin, was a bull at $400 per share when the share price was this high. And so, or at least that's what I think. Guys, correct me if I'm wrong. Was he a bull at 300? I'm pretty sure he was at least a bull at $300 per share. He might have been at 400. You guys let me know because I could be wrong and I don't want to misquote him. But I question if they have built reasonable models, and here's why. This is the model where most YouTubers fall into, and so they fall into that 30% growth camp, 30 to 35. So what I took was I gave them, the 60% growth for automotive sales that they're going to get in 2022, and then beyond that, I'm growing at 32.5%. And notice I'm not slowing it down. These other segments, they could slow down. You could technically increase these other segments at high rates, but effectively, look, total revenue growing at 32%, 30, 28, 29. So effectively 30% on average all the way through. So this is pretty much in line with how these other YouTubers are forecasting the top line growth out. They don't break out a full model, so you don't know how they forecast everything out normally, but also notice that the margins are pretty high. So the cost of sales remains at around 73%. And so, they're getting 27% margins on their revenue. So this is a very bullish model. But here's the problem. The valuation that this model gets you to is approximately $250 per share. So I question these YouTubers' bullish stance because they were bulls at $400 per share, but their estimates only get us to a reasonable valuation of $250 per share. So how were your estimates different when the company was trading at $400 per share? Were you forecasting 70% revenue growth, 80% revenue growth? What were you forecasting? Because that's a real challenge, something that you're going to really have to explain. And I'm not really calling anyone out. Don't, message these guys or bombard their, comment section or whatever. I'm not calling them out. I'm speaking more on a high level. If you were a bull on the security at $400 per share, what did your estimates look like? Because I just took your revenue growth estimates, I slapped on high gross profit margins, and I'm still only getting to a $250 per share valuation. And so I'm done hammering on these people for now. But the point that I want to make to you guys is that there's something very important when it comes to security analysis. And it always comes down to rule number one: don't lose the money. In fact, I should probably just change the name of this channel to rule number one, because all I do is talk about downside protection or downside risk, right? And so, I'm going to provide to you guys, or I have provided to you guys, a super sophisticated stock analyzer tool, which you can actually access for free in the description below. And I'm just going to talk about that right now. So you can see here's the super sophisticated stock analyzer tool. And really, the point of this tool is that there are no tools or shortcuts with investing. You have to do the work. And, when it comes to the questions, the first question is it something that you understand? The second question is, does it have favorable long-term economics? The third question is, do they have competent and willing management? And the fourth question, and this is the whole point of this video, is the company selling at an attractive valuation? In order to determine if the company's selling at an attractive valuation, you got to look at the intrinsic value. Don't look at the next year's price target. And so you have to do the work. You have to calculate it on your own. And you have to ask yourself, is the intrinsic value substantially higher than the current share price? And then you have to ask yourself, are you getting a high enough margin of safety? Because a high margin of safety is our best safety against errors in analysis. So in other words, valuation matters. Now, there's a lot of people who are angry at that video that I put out on Tesla. But the point that I'm making, and I'm making this with compassion, is that if you focus on valuation and downside risk, you may not have lost 70% this year. I'll leave it at that. And if you guys haven't seen my video that I put out earlier today, where I went through the valuation of Tesla, you can get to that video right here.